joining us this morning. Good morning, Rajesh. This is Harsh here. Rajesh, let me start off. Your base has gone up overall in terms of the loan book size. Now at this 27,000 crore AUM, you've guided for 30% growth at least for the next 2 to 3 years. What are the levers that you're going to use to ensure that that growth comes through for you? Is it going to be new geographies, new branches, going in deeper? Give us a sense.
Thank you. So the growth is coming from primarily from funding to small borrowers through our product of the gold loan, MSME, affordable housing, and retail construction finance. These are the four products we are doing. And we have seen last couple of years, there is a positive price trend in the gold, and there's a cultural shift in borrowing from the formal segment by pledging the gold jewelry. So I think gold is going to be the biggest contributor in the overall growth parameter. Plus affordable housing on the back of Pradhan Mantri Awas Yojana and low cost ownership in the still affordable housing segment by the small borrower who are buying their first time home. I think that segment is also growing at a pace about 40-45%. So I think these are the two major growth drivers. MSME and retail construction finance will continue to grow in the range of 20-25%. So overall, even at our base of 27,000 crore AUM, we believe there's a lot to be done, and easily to target a 50,000 crore book which we are projecting. I think that is achievable in India landscape. Still, there is a lot more runway available. And we have seen the positive collection cycle also, that also giving us a lot of confidence.
Okay, Rajesh, morning. Also wanted to understand about your gold loan portfolio, because that obviously has risen quite sharply and the mix now is nearly about 40% gold. What is it that we can expect in terms of gold as part of your loan mix over the next 2 to 3 years?
The gold should be in the range of about 45% plus minus 2% here and there. For the reason being that we have opened more branches there. So almost we are now close to 860 branches. By January end, we will be close to about 1,000 branches. And last quarter, if you've seen, we added total 86 branches, majority of them will be gold branches. So the coming quarter, this quarter, ongoing quarter, in the coming quarter, there's a lot of expansion happening in the gold, partly in MSME, partly in affordable housing put together. We intend to end the year in the range of about 1,350 to 1,400 branches put together. And on back of that, we are adding capacity and capability both. And with these additions, I think we are quite equipped to target the next year growth. All these branches opening are happening not for this year target, but for the upcoming year's targets.
Trying to understand how MSME is playing out for you. It was a larger chunk of your portfolio. It's come off because gold has grown really, really fast for you. Is there any stress you're seeing on the book? And is that possibly one of the reasons why you've calibrated your loan mix towards gold? What are you seeing in terms of a trend with regard to MSME asset quality?
MSME, we primarily have slowed down because we have diverted our capital allocation, the debt line to the gold loan. In the view of that, we opened 750 branches at once when we started the gold loan. Second, MSME, we have seen some stress in some pocket, but we being collateralized and secured, our credit cost is not changing much. The gold loan have done well in terms of growth, but in terms of asset quality, definitely that is not equal to the gold loan. So asset quality wise, while in the unsecured MSME, where a lot of stress have happened because of the people have borrowed multiple loans, but in the collateralized segment, I think still we having the collateral, we have a right to recover by disposing of the collateral property where we don't take any call on the legal and technical. That segment still we continue to grow 20-25%, and we are not seeing much stress there, barring that the delinquency has gone little 50 to 75 basis higher than the previous year.
The other thing we wanted to understand, Mr. Sharma, is also co-lending and the economics of it. How does it really work? Is there a default loss guarantee that you actually have to give?
Now, co-lending is a wonderful tool where the low-cost funding of bank and the low-cost collection efficiency and origination capacity of the NBFC do collaborate together, and ultimately, the customer who get the benefit, and that is the whole purpose of this co-lending. It is a very highly ROE security because we did not to put any capital for the share we set aside for the bank and bank participate in that. And in the books of the bank, it classifies the retail portfolio rather than classifying as a lending to NBFC. So it's a win-win situation where bank exposure does not get consumed to the NBFC sector, which is already reached at the peak at most of those banks. So ultimately, the customer is benefiting. NBFC is benefiting because they are getting the low cost fund and target those customers which otherwise they cannot target. Customer is benefiting because they are getting the last mile connectivity origination capability of banks, but the NBFC, but low cost funding of the bank. So it's a win-win situation for the customer, for the NBFC, and for the bank.
Okay. Uh, so with regard to cost of funds, is there scope to improve it further is what I'm trying to understand. Uh, Given or say there is no rate cut, is there still scope for improvement in cost of funds from here? Give us a sense of that.
Is a very good question in terms of because it is going to do the major impact on our profit and loss. If we save 50 basis and the 4-time leverage, it has an impact of 2% pre-tax ROE. It's a huge lever for any lending institution. Last 6 months, a lot of banks have reduced their MCLR, but that effect come on the reset date. We being the majority of the funding is coming from the banks. On these reset dates, the loans are getting reset by lowering by 20 to 30 basis. Plus, our rating have been upgraded to AA minus. So there also we are getting a lot of advantage in terms of risk weightage. And with that mix of both these combination of the banks reducing their MCLR and our risk weight is going down, our likely cost will be reduced by end of March at least 30 basis, and by the next September at least 50 basis cost will come down, and that will give us a huge edge, not only passing on that benefit to the customer but also some benefit to the P&L.
Right. Okay. Mr. Sharma, great to have you today on ET Now. Thank you so much for your time.
Thank you so much.